Nicknamed the Great White North, Canada is the second largest country in the world and is so vast it boasts the world's longest coastline at over 202,000 kilometers, while its border with the United States stretches an incredible 8,891 kilometers, longer than any other bilateral boundary. However, despite its vast size, over 90% of Canadians live within 100 miles of the US border, and 50% of Canadians live in this red area. A high quality of life, excellent healthcare, and a strong education system have long made Canada a desirable place to live. But recent economic trends suggest that times have changed. Canada is becoming impossible to live in. At the forefront of the issue is Canada's housing crisis. It has experienced one of the greatest housing booms in the world in the last few decades. Since the early 2000s, average house prices have more than doubled, with prices skyrocketing far beyond the reach of average earners. Vancouver is Canada's most expensive city, with a median price to income ratio of 12.3, placing it as the third least affordable city in the world, behind only Hong Kong and Sydney. In addition, Toronto ranks 11th and is also classed as impossibly unaffordable. The severity of Canada's housing crisis becomes apparent when examining the stark disparity between housing costs and income growth. Between 2000 and 2021, housing prices in Canada soared by an astonishing 355%, while median nominal income increased by a mere 113%. This widening gap has resulted in one of the highest house price to income ratios among OECD member states, significantly outpacing other developed economies. This chart shows the change in the ratio of average home prices to average disposable income in Canada from 1975 to 2023. Now let's compare that to the US. As you can see, since 2006, a significant disparity has opened up between the two nations, with Canada's house price to disposable income ratio far exceeding the US. Since 2003, the average price of a new house and land in Canada has nearly doubled, while during the same period, average hourly wages have only increased by approximately 25%. This disparity is particularly evident in the rental market, where the average rent for a two-bedroom home in Canada has increased 70% faster than wages since 2018. The impact of this affordability crisis is particularly evident in major urban centers. In Toronto, a family would need to earn approximately $280,000 annually to purchase an average home, more than double the city's average annual income of $122,000. The situation in Vancouver is even more dire, with the average home price approaching $2 million, requiring a family income of roughly $360,000 per year, a figure that dwarfs the median family income of $70,000. The rental market offers little respite from these challenges. Canada's rental vacancy rates have plummeted to an all-time low of 1.5%, leading to fierce competition for available units. It's not uncommon for hundreds of applicants to vie for a single apartment, highlighting the severe shortage of affordable housing options. Thanks to this low supply, the average rent for a one-bedroom apartment in Toronto and Vancouver has climbed to nearly $3,000, forcing many renters to make difficult choices between basic necessities. The causes of Canada's housing crisis are multifaceted, but a primary factor is a severe shortage in supply. Canada has the lowest number of housing units per 1,000 residents in the G7, with only 424 units available. This figure not only highlights the severe imbalance between housing supply and demand, but also underscores the fundamental inadequacy of Canada's housing infrastructure to meet the needs of its growing population. This shortage is exacerbated by a declining number of homes listed for sale since 2015, and a sharp decrease in available rental units since early 2020. The magnitude of the housing deficit is staggering. CIBC estimates that Canada needs to build 5 million more homes by 2030 to achieve affordability targets. However, local governments have shown reluctance to invest in housing development. Restrictive zoning has been in place since the early 1990s, meaning that most residential land in major Canadian cities has been exclusively zoned for single-family homes only. Such zoning restricts higher density, lower-cost residential development in cities, such as townhouses, duplexes, and multifamily housing. As a result, the supply of new housing is lower than it should be, and the cost is high. In Vancouver, single single-family zoning accounts for 81% of the city's residential land area. This is the highest among major Canadian cities, contributing to it becoming the most expensive housing market in the country. Acts of NIMBYism, or not in my backyard, have further complicated efforts to address the housing shortage. Many local governments face significant pressure from existing homeowners to limit new developments, resulting in a severe shortage of housing units relative to demand. This resistance to development has created artificial scarcity in urban areas where population growth has been most pronounced, further contributing to the affordability crisis and leaving many Canadians struggling to find adequate and affordable housing. The consequences of this housing crisis extend beyond immediate financial strain. A concerning trend is the rising age of first-time homebuyers, with many young professionals finding homeownership increasingly unattainable without significant financial support. This delay in homeownership has far-reaching implications for wealth accumulation and financial security over the long term. Several factors on the demand side have created this perfect storm in Canada's housing market, with a significant increase in immigration at the forefront. Excluding the pandemic, the recent years have witnessed Canada's population grow much faster than the preceding decades. In fact, Canada's population grew by over 1.2 million people in 2023, the highest annual growth since 1957, driving the country's population to a record 40 million. This record growth is fueled by international migration, with temporary and permanent immigration accounting for 97.6% of the population growth. More people moving to Canada means there were over 1 million people looking for homes in the past year alone, with demand far outstripping supply. This rapid population growth has come at a time when interest rates in Canada were very low, particularly between 2009 and 2022, making borrowing affordable for a large population and driving demand. These low interest rates have enabled individuals to borrow larger sums than they could previously afford, thereby increasing demand and contributing to the inflation of housing prices. This artificially stimulated demand has created a self-perpetuating cycle of rising prices, further exacerbating the affordability crisis. Foreign investment has emerged as another crucial factor in the escalation of housing prices, particularly in major urban centers. For a long time, foreign and local investors have been purchasing residential real estate in Canada, competing in the market with those looking to buy a home to live in. This influx of foreign capital has not only driven up prices, but has also distorted local housing markets, making them increasingly inaccessible to domestic buyers and long-term residents. In 2023, the federal government banned foreign nationals and enterprises from buying homes in Canada for a period of 2 years, so that houses could be used as homes for Canadians instead of becoming a speculative financial asset class. In 2024, the ban was extended for another 2 years. This combination of factors has created a self-perpetuating cycle of rising costs and diminishing affordability. The repercussions of this crisis extend beyond the housing market itself, impacting overall financial stability. The average household debt in Canada has reached alarming levels, now standing as the highest among G7 countries when measured as a percentage of disposable income. This high level of debt is placing significant pressure on Canadian households, limiting their financial flexibility and resilience in the face of economic shocks. When comparing the costs of common goods and services between Canada and other G7 nations using purchasing power parity, a disturbing pattern emerges. Canadians consistently face higher prices for essential services and everyday necessities, significantly eroding their purchasing power and quality of life. Perhaps the most striking example of this disparity lies in Canada's telecommunications market, which ranks among the most expensive globally. Mobile data is 26 times more expensive in Canada than in France, and 61 times more expensive than in Israel. This extreme pricing is largely attributed to the oligopolistic structure of Canada's telecommunications industry, where a handful of major players dominate the market. The lack of robust competition has allowed these companies to maintain artificially high prices, leaving consumers with little choice but to pay exorbitant fees for what are now considered essential services in the modern world. The inflated costs extend beyond telecommunications into other crucial sectors of the economy. Canada's Canada's agricultural industry, particularly in dairy and poultry, is heavily influenced by supply management policies. While these policies aim to protect domestic producers, they come at a significant cost to consumers. The average Canadian family bears an additional burden of nearly $450 per year due to these protectionist measures, further exacerbating the affordability crisis in a country where grocery bills are already stretching household budgets to their limits. While the cost of living for Canadians is high, wages remain stagnated. Productivity measures how efficiently an economy converts inputs into outputs, reflecting technological advancements, innovation, and overall economic efficiency. However, Canada's productivity growth has hit a concerning plateau, with output per hour worked in 2023 actually lower than it was in 2014. This stagnation is not merely a temporary setback, but a long-term trend that has significant implications for the Canadian economy and its citizens. The productivity gap between Canada and other advanced economies is both significant and concerning. Perhaps most striking is the comparison with its closest neighbour and largest trading partner, the United States. Canada's productivity lags behind the US by a staggering 30%, a gap that translates to approximately $20,000 per person per year in economic output. This widening productivity gap between the two nations is being felt directly by Canadian workers, whose wages are approximately 8% lower than those of their American counterparts. The severity of Canada's productivity problem becomes even more apparent when viewed through the lens of international rankings. In 1970, Canada held a respectable 6th place in the OECD productivity rankings. However, by 2022, the country had plummeted to 18th place, a decline that spans over 5 decades and multiple economic cycles. This downward trajectory raises critical questions about the underlying causes of Canada's productivity woes. One key factor is the lack of investment, particularly outside the realms of real estate, construction, and public services. Canadian businesses spend about $13,000 per worker on capital, while their US counterparts spent $20,500, a shortfall that significantly hampers productivity growth and innovation. Canada's resource extraction sector, while historically significant, is also facing mounting challenges. Employment in the oil and gas sector, a key driver of Canada's resource-based economy, peaked in 2014 and has since declined by approximately 23%. This downturn highlights the vulnerabilities inherent in Canada's economic model and raises questions about its long-term sustainability in the face of shifting global demand and growing environmental concerns. Canada's current trajectory presents a sobering outlook for its future, and many will find living there extremely challenging for the next few years at least. If you want to learn more about the current state of one of Canada's major trading partners, head on over to this video where I show you just that. Thanks for watching, and see you next time.